How to identify liquidity in trading. Welcome to the channel. My name is Nexus, and in this video, we're going to talk about how to identify liquidity in trading, specifically how it relates to Forex or futures trading. So I'm going to talk about three main things. What is it? How do we use it? And why do we actually care? So I'm currently looking at New Zealand yen, and this is TradingView. And I'm on the monthly chart right here. I'm going to use this as an example to explain these three things. Now, just a little tip, I have created a separate video that talks about liquidity. You should be able to find that video in a link somewhere at the top right, I believe. But in this video, let's go through these three main things. So before we actually start, let's just talk about the labels, the actual word liquidity. So it is very possible, especially for me when I got started, I found this very confusing, is the term liquidity might be used interchangeably with other terms. So you might hear the term liquidity zones, or you might hear the term liquidity pool, or stop hunt or termination zones. The key here is that we are only, as it relates to Forex, interested in orders, where orders will reside. Okay, so where orders reside on the chart. We can't see them. We don't have any indicators that tells us where they are. So we need to figure out where the orders reside. Now, in simple terms, why are we interested in that? What's the interest? Well, the interest is that if we know where orders reside, then we know as traders when we can time our trade. So we are not in a trade, we can use it as an opportunity to enter a new trade. Or if we are in a trade, we can use it as an opportunity to exit a trade. So this is what liquidity is. Let's talk about how we can actually find it. So in this example, we've got a swing high right here, okay, and a swing low right here. Swing low right here, and a swing high right here. So orders or liquidity will reside above a swing high or a swing low or equal highs or equal lows. So for example, right here, you actually have equal highs. So you'll have liquidity resting above that. You've got a high here, liquidity, low liquidity, low liquidity. Now, we don't actually know 100% if there is actually orders residing at those levels. We only know based on the reaction of price. So if price reacts to that level, then we know that liquidity or orders existed at that level. So let's have a look at this level right here. So we've got this bar. The high of this bar is 83. Let's look at that. That's 83.91. And then here is 83.80. So right here, price goes above, takes out the orders, and what does it do? Runs down. So we know that there were orders or liquidity at this level. Let's look at this level right here. This one should be obvious. So right here, okay, right here, we had a low. That low was taken, so a stop hunt. And what happened to price? You can see the reaction. So we know based on what price has done after that there were orders or liquidity at that level. So that's how we find them above old highs and below old lows, or equal highs and equal lows. So let's get to the next part, which is why do we really care? So I've already mentioned that the reason we care is we can use it to enter trades or exit our trades. So let me use this. I'm going to use the replay button to explain what's happening in this price leg. Okay, so let me grab the replay. I'm just going to take away this level here. Okay, so let's just assume that this is all we can see, this price leg. We don't know if price is going to carry on going lower to take out these lows or just to go up. Okay, I'm just going to refresh my chart. Okay, so we don't know. We don't know. Okay, so the first step really is to understand or think about where price is going to. What is the draw on price? Where is it likely to get to? So we know at this point it's taking out that low. So we can assume potentially that there might be orders in this level, but we don't know. So we wait for a reaction. Let's see what happens. Okay, so price is reacting to that level, and I'm just going to play it real quick. Okay, so I'll keep playing it until it goes above that high, this high right here. Okay, all right, cool. So right now we know, because price has gone above this short-term high, we're now confident that price is going up. But going up to where? Well, you need to know roughly where it's going to. So as I explained in the other video, you need a draw. You need a destination. Your car is not going to get anywhere without knowing exactly where it wants to go to. And why we need that information is so that we can identify the probable best possible place that we can then take advantage of that movement. So where orders will reside between this level here, which is point 0, or the beginning of your journey, and to some destination halfway between point 0 and the final destination. I say final. We're going to assume a destination, and just for argument, let's just say this level right here is our destination. Okay. Yes, a little bit of hindsight, but let's just say for now, this is the level. So price is currently here. We know it's broken this short-term swing high. So we're confident that price is going to reach some level. It could be going back here to this level. It could be going here, or it could be going here. And let's just say it's going here. Now, the best place for a new stop hunt to occur will be at the midpoint of the level from this low to this potential high. We don't know. We are predicting or anticipating that price will go there. So the best place to identify your liquidity or your orders is halfway through the journey. Yes, it is possible that between point 0 and halfway, it will have stop hunts, especially on a lower time frame. So remember, we are on a monthly time frame. We're just using the monthly right now. So where is the likely place for the next stop hunt to take place? It's halfway through. So if we take a fib, again, we're going to project into the future, and we take this low and this high, halfway through is this level. So you're watching this level. You missed the trade here because you didn't enter the trade. This is potentially a place you could enter the trade, potentially. Okay, you could potentially enter the trade here. You have a little fair value gap right there. But let's just say all you're looking for is that stop hunt, right? You're looking for a stop hunt. You're looking for the point where orders are just grabbed and the price moves in the same direction, right? So orders are grabbed, they take your orders, and then they just carry on going. It's likely to happen at this midpoint. So let's see what happens. And in order to kind of show this, I'm going to remove the wicks so that it's a little clearer what's actually happening. All right, so let's play this. Okay, so we're at the midpoint. So you're not in the trade at the moment, but you know it's heading to this destination. So this is the most likely place price will do a stop hunt or consolidate or find orders. Okay, there you go. So we swept that low. Oh, and then we're rapidly moving. And at this point, you've probably missed that entry if you haven't taken it, because it's going to rapidly move to the destination. There's another area right here. You've got a fair value gap. So there's a second opportunity there. And then let's see how it gets to its destination. Okay. So there we go. I'm going to put the wicks back on. As you can see, we're at the destination. So I'm just going to close that. And there you go. So the midpoint, now you can get potentially stop hunts from the 0 to the 75 or 25% level. So it can happen again. But the optimal place that you will find these stop hunts or these orders that will be grabbed is at the midpoint. Right here, just ignore the wicks. Price goes up, goes down, goes up again. So at this point, you're thinking, it's going up. It's going up. It's going to the moon. It's going up. But what happens? It goes right back down, takes out the orders. Okay, so ignore the wicks. Ignore the wicks. Look at the bodies. It takes out the orders right there at the 50% level, which is the optimal place to find liquidity. And then it runs to its target. And that's it. So there you have it. This is how to identify liquidity in trading as it relates to Forex and features. The best optimal point to find this liquidity or orders in any price range is at the equilibrium of 50%. So you need to forecast. In order to forecast, you need a destination or a final point, and then you measure that move from the low to that final point. Yes, you will adjust it over time. So I hope this video was helpful. Please like this video because it alerts YouTube's algorithm and really helps to promote the video. Also subscribe to the channel for more helpful tips and videos. Thanks for watching. See you in the next video.